Look, I certainly see this trends of dovish central banks continuing throughout the Asia region, and I do think certain countries will continue to cut rates. Our view is that the RBA will probably cut rates at least one more time over the next 3 to 6 months. GDPs are 1% lower than where it was this time last year, and there's still no inflation or wage inflation because unemployment is still too high. So the fundamental picture, at least in Australia, probably justifies another rate cut at some stage. Even places like India, for example, growth is very sluggish there. They're probably going to print mid 4% GDP quarterly print, which for them is at multi-year lows. So they'll likely cut rates again, maybe once or twice in the next 6 months or so. Korea, the market's pricing another 25 bips of cuts over the next 6 to 12 months. So the general theme around Asia is not dissimilar to other parts of the world, particularly in Europe, where growth is slowing and central banks will remain dovish going into 2020.
And Raymond, how does this factoring into your overall investment strategy, particularly when we talk about Asia and India?
Well, look, I think you want to position a portfolio where rates will remain lower for longer, and that's something what we've done. So you want to build a duration in your portfolio, whether that's in Australia, New Zealand, or even in some of the emerging markets like India, where the carry is a little bit higher. Rates are likely to go lower there because growth is still fundamentally not as strong. We do like some currency positions. We have a slight positive for the US dollar. We think there's some tailwinds there. The interest rate differential between the US and Europe is still quite high. There's still $1 trillion of corporate tax profits that's going to go from offshore back into the US because of the tax advantages due to recent tax law changes by the Trump administration. So there's a tailwind for the US dollar. And then specifically, we still like credit assets, things like mortgage-backed securities in this part of the world, tier 2 bonds. Spreads in some buckets are still relatively attractive. They're trading at very low in terms of volatility metrics, and so they may give you extra carry and looks to be a good risk return during this type of market situation.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.